So I made a video yesterday updating you on the swing trading strategy of using commitment of traders to swing trade on the 4 hour chart. So if you want to go back and watch that video from yesterday, I believe it was yesterday, you can go and do that. That will highlight the strategy and talk more about commitment of traders as a refresher. Today's video is going to be an extension of that. I was asked, I've made the statement a couple of times when I've done this strategy video that the actual entry and exit points are beyond the scope of the video. And I've kind of left it there because I just didn't want to make the video an hour long, and it really can just get messy. But I did get a message from someone asking me like, oh, you always say you don't want to talk about entries and exits, but can you do a video just highlighting how you do it? So let's talk about that today, and I'll try to keep this as brief as possible. So again, I'm not going to rehash the whole strategy again. You can go back and watch the video from yesterday. But essentially, what the person was asking is, okay, well, so you see a potential setup. How are you deciding whether you're getting in and when you're getting out? All right. Well, the answer to that, like I said, can be a little bit messy because there's 100 different ways. You can use just simple price action. You can use market structure. Higher highs, higher lows, lower highs, lower lows for downtrends. In breaks of structure. You can use volume, especially if you're trading in futures. If you want, I don't use volume profiles, whatever. You can use candlestick patterns. You can use indicators. Okay. So it really just depends indicators such as oscillators, things like what you see on the chart here is the stochastic RSI. You can use RSI, stochastics, commodity channel index, MACD, whatever the heck you want. Moving averages, moving average crossovers. Okay, so it can get a little bit messy, and there's a lot of options here, right? So that's kind of the takeaway point. Okay, so let me just show you one way you can do this. Now, I use market structure, and occasionally I'll use an indicator like the stochastic RSI. So if we look at, this is, let me go to Rice here. So this is Rice. Now, again, according to the COT, we are in a bullish stance here. Here's our COT index. Again, I'm not going to rehash all this. So we're looking for longs. So we go back down to our 4-hour chart, and if we go back to starting at like this low right here, because the market was in a downtrend, and this is about where the COT index started to go more bullish. So let's start from here. We can even ignore this first one because at this point we didn't know the uptrend was really starting. So we'll go right to here. So this is the stochastic RSI indicator. This is a free indicator on TradingView. It's at the default settings, which you can see down here underneath my picture. It's at 331414 set to the close. You can change that if you want. I just left it on default, and I left the default extreme long or overbought, oversold areas, which is right here where you see my pointer. That's the 80 level for overbought and the 20 level for oversold. And I do have the 50 level, which is like right in the middle right here. Okay, so again, we're looking for longs, right? Because we've already established that on the COT. So we have an entry right here. So essentially what you're waiting for is for the price, for the indicator to come out of the oversold area and start to break higher, which you can see right here. Let's see if I can just expand this. Whoops, a little bit. Okay, you can see this right here. So we're, here, anywhere in here. Now we did break out right here. Okay, and then it did come down again. So you may have had a false breakout right here because you can see technically in real time it came in right here, and then but then we had this big flush and dump. This is basically the last liquidity grab before the real move happened. This is very, very common, and unfortunately it's just you have to be ready to take that kind of stuff. Okay, whether you get stopped out or you go into drawdown. Now, if you had your stop loss below this swing low over here, then you probably would have been okay for that. And then we get this next signal right here, and this is the valid signal. And you can see price went up, all right, and then you can see it pulled back. And again, we are on the 4-hour chart here, okay? And then you see it went up, it made a new high, it pulled back. You can again see the stochastic RSI dip down below the 20 line, okay, and then started moving back up. There's another entry there. Now right here, there was a minor entry. You can see the indicator only got to the 50 level because there wasn't a ton of selling. You can take trades using this indicator off a 50 level cross, but they're not as good. They're not as strong. And chances are they're not going to go as far. If you go back and you look at these type of, with this indicator, you look at this signal, you're going to find often that it does not go very far if it only comes back to the 50 line. So you can take this trade, but as you can see, it only went a little ways and then it pulled back again. Then we had a deeper retracement and then we had another signal right here and so on. Okay. So that's one way that you can do this. Okay. You can use any other indicator you want to. You can use market structure. Okay. So let's say we kind of at this point, we established that we're now looking for longs. Okay. So the COT told us from about this area here, we're going to start looking for longs. So we're going to wait for our first pullback. So if we highlight this area right here, okay, and then we're going to say, well, I'm going to look for a switch in market structure, a flow back to the upside. Well, it's a little hard to do that on the 4-hour chart, although you can, because this one's a little bit, sometimes it's really hard to tell because all the candles on the 4-hour chart are, look like they're all heading down. And when you really see that move to the upside, it's already gone really far. So one thing you could do is you could drop to a shorter time frame. From the 4-hour, I'd probably go down to like a 15-minute chart. And if we look at that area on the 15-minute chart, you can see right down, we have this swing here, up, and then we come back to this common low, and then we come back here again and drop. And then finally, we start to see a market shift here. So in this situation, the indicator would have been just as good as the market structure shift. Okay, now you can go to an even shorter time frame. This gets really confusing, especially for new traders. You start getting lost in the minutia of the candles on the really short time frames. So while you can do it with market structure, sometimes it's very clean. And if the swing highs and swing lows are very obvious and they're tight together, then when that market flow begins to shift the other way, it's very obvious. Now in this one, like I said, you didn't get a break. If we consider this the last swing high before this low was put in, we didn't get a break on this until this candle right here. And look at the size of this candle. But look where our indicator was. If we go back to the 4-hour, we mark it off on the on the stochastic RSI. All right, that break actually happens on that candle too. Okay, so in this case, you could have done it either way, right? You could have either taken this market shift here, or you could have taken the RSI signal on the 4-hour. Now on this one, you actually had a signal on the 1-hour, on the 15-minute chart. You had the stochastic RSI come out here, which would have gotten you in down here. That's another possibility too. So you can see just using this one indicator or market structure, you can see how many different possibilities there are to coming up with your entry signal. That's why I hate always talking about this, because there's so many ways. Again, in this case, there was a signal on the 15-minute chart right here, and that would have gotten you in very early, and you could have gotten in and grabbed all of this. But sometimes you're going to get that signal, and it's going to be a false signal, and it's not going to go anywhere. And, you end up being stopped out or into drawdown. So, having more signals doesn't necessarily mean better signals. It just means you're going to get more of them. But you have to be willing to live with the fact that sometimes they're not going to be as good. Okay, so that's the stochastic RSI. So let me just go back here, take all these drawings off the chart. This is back to a current price. So you can see all of these. All right, now maybe you could use the 1-hour chart too, right? We go back here. Here's the 1-hour chart. and we get that signal right here, that's actually pretty good too. So maybe instead of the 15-minute, you use the 1 hour. But then again, we have a 1 hour signal right here, a little bit before this one, right? This was the good one, but you come and look at this one right here. This one is bad. You get this signal right here, and then what does price do? It goes up a little bit, and then boom, drops again. If you have your stop sitting right here, you got stopped out. Now, if you had your stop down here, fine, you would have, had some drawdown, but you would have survived it. But it still wasn't the best fill. So that's the perfect example of what I'm talking about, where you can go to shorter time frames. You're going to get more signals, but they're not always going to be good. But on the flip side, if you use the 4 hour, it might be a more reliable signal, but it might get you in later, okay? Because remember, every indicator is delayed. Every indicator is delayed, okay? Because it has to use past price action in order to calculate how it's, graphed on your chart. So it has to wait for price data to become available before it will paint. And by then, price has already started to move. Now, hopefully it's a small move. In this case, it was a really big candle when you got this signal on the 4 hour chart, right? Here's the signal right here. This is a kind of a worst case scenario because you had price move up with this giant candle. It broke structure. But if you got in at the close of this candle, because typically you're going to wait until the candle closes, then yeah, price did go up a little bit, but it didn't go far. You can see it spiked way up here, came all the way back down, tried to go up again, and then boom, a big drop. And then, but again, you could have held this through this chop. If you had gotten in here, had your stop loss sitting down here, let's say, fine. You would have gone into some negative drawdown here because you got in again at the close of this candle. Price gets down here. Your stop loss is down here, presumably, or somewhere out of the way. And then price did go up. So this trade still would have played out in the end. But you can see the variability, which again is why I don't like always talking about entries and exits, because there's 100 different ways to do it. Or you can just look at candlestick patterns. You don't even, don't use any indicators. Or you can use Heikin Ashi candles. If I look at this, here's that signal on a let me just make sure I'm looking at the right one. Let's just drop a line on this one. Make sure we're looking at the right one. If we go to Heikin Ashi candles, here it is, right? We did have a false break. Here's that false break again. If you're just looking for the Heikin Ashis to turn bullish again, you had these two right here. You would have gone long, boom, price dropped. If you had your stop low enough, you would have been saved, and then it went. So you can use Heikin Ashi candles. You could use moving average crossovers. I just for the sake of this video, I threw, this is a 9 and 21 period SMA on here. So you can wait for the moving average to cross over. This one, I don't like these at all. These are way late signals. Here's the crossover right here, right? We get this crossover right here, okay? And if you look up, here's the candle that crossover happened. Well, what happened immediately after that? Price pulled right back, tried to go up again. If you got in at the close of this candle, all right, you went into profit a tiny little bit, and then boom, a big drop. And again, it did eventually go up, so you could have held through this, but it's a late signal. But again, it's legit, though, if you want to use it. It just got you in, a little bit late. So, and again, this is staying on the 4 hour chart, which, makes it the simplest, so you don't have to go to shorter time frames and get lost in the minutia of a lot of different price action. But still, this is the, this is the way to look at it on the 4 hour chart. So again, we'll review it again. You can use indicators, oscillators, moving averages, price action, market structure, Heikin Ashi versus regular candlesticks. And you're just looking for the color to change, right? Whatever. So there's 100 different ways to enter this trade. Okay, and the same is true, obviously, in a downtrend. Prior to this, the COT changing direction, this thing was in a steep downtrend for a couple of years. You can go back here and you can look at the stochastic RSI giving you signals to go short. So again, in this case, we're looking for the indicator to come up here, ideally into the overbought region, and then look for crossovers and back out of it. And those are your entry points. And for the most part, they're going to be pretty good signals. Sometimes they're going to be early. Here's one right here, right? We have this signal right here, right? RSI, oops, I can't do it because it won't cross over into that. Right here, stochastic RSI closes below the overbought line. But if we look at where that is on the chart, it's right here. We get this one candle close and then price goes up. And then it comes down and it goes up again. So all of this you would have had drawdown. Maybe you even been stopped out. You went short right here. Well, where's your stop loss? I don't know. But, you know, obviously this price action hadn't drawn yet, so there would be no stop loss right here. Hopefully you had your stop loss up here, give it some breathing room. And again, you would have gone through 2 or 3 days of drawdown here, at least, because these are 4-hour candles. And then eventually it did drop. So there's that one, and there's this one here, which was a good one. You went into a tiny little bit of pullback right here, and it went down, so on and so forth. And then there's all these minor entries right here, where the stochastic RSI got to the 50 line, maybe a little above, and then dropped. And you can see why the pullback candles are very, 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 very tiny. If you look at right here, and you come up and look at the chart, little tiny pullback candles, right? And then, you know, the price continues. This is all basically one big leg. So you can take these RSI, these stochastic RSI crossover signals from the midline, but, you know, they may not be as reliable. Sometimes they're going to work out great. Other times they'll be, you know, very small moves because it's just kind of showing that there isn't a lot of volatility at that level. But sometimes they're good continuation trades. So you can continue to see that. So that's why I like the stochastic RSI. I like it better than MACD. I don't use RSI. I don't like the regular RSI. I think it works better than a regular stochastic. It kind of like is a combination of the two indicators. But again, it's going to have a delay like any other oscillator. It is delayed because it's calculated using prior price data. Okay. But again, you could, you know, drop to a shorter time frame and look for a signal on the shorter time frame for when that signal comes. So on the 4-hour chart, once it gets up into this, like right here, it gets up into this overbought area right here, right? Now you get the signal on the 4-hour chart right about here, which is on this case is still pretty good because what happened was when it started going down again, it paused, right? The candles were very small at first. It took a little while for the momentum to get going and then it dropped. But sometimes you have just a big steep drop. You have one giant bearish candle. And if you wait for that candle to close and then get in, then, you know, you may be late to the party. This is an ideal situation where you get the crossover, you get one big bearish candle, but then it goes on very, very slowly for the next 12 hours, just tiny little candles, because the sellers were just kind of like priming up here, and then it finally dropped. So in this case, that entry would have been fine. But if you go to the 1-hour chart, we look at this. This is August, just so we keep our place on the chart here. Okay, here it is in August. And so you can see it, on the 1-hour chart, the signal was actually back here at the top. So you would have gotten in a little bit quicker, and then you would have gone into this sideways, and then it dropped, okay? So again, it's risk reward, right? You take a signal on a shorter time frame, you run the risk that it's a false signal, but if it works out, beautiful. If you want to stick to the higher time frames, more conservative, but understand you may be getting in late, depending, especially if that entry candle is big. It's like an engulfing candle and it goes really far and you're waiting for that candle to close, you may be getting in late to the party. But in this case, if it's a small candle, on the 4-hour chart, you know, the initial candle is kind of like this, and then you've got plenty of time to get in. Price just kind of tracks sideways for a while, and then it drops. Okay, so you guys kind of get the hint here, right? So in terms of exiting a trade, so now we've talked about entry, right? Again, guys, you have to decide what works for you. For me, I like to use just visuals. I like to use I don't want to use 25 different time frames, okay? So what I'm going to look for is like engulfing candles, key levels, you know, people like using Fibonacci levels. Okay. Maybe Fibonacci levels work for you, you know? So something like that. Um, so like I said, you have to decide what works for you, you know, what works best. Okay. Now, in terms of exiting trades, well, it's pretty much the same thing. It's just the opposite. So if we go back here, right? So now we're looking for long. So as the price goes up, fine. Okay. So it gets up we take this signal, it gets up into the overbought region, and now it starts to turn and come back down. Now, again, this is where the delay in these indicators and also just looking at the long time frame is going to work against you, because you can see you get the crossover right here. Well, price has already come all the way back down, and your trade now is probably at near break even. So you're in profit, but you let it come all the way back down. And now by the time you get this crossover to the downside out of the overbought region, you've already given back most, if not all, of your profit. Okay. So that is something to keep in mind. All right. So again, what you could do in this case is use a shorter time frame. So if we mark out the high here, there's the high of this move up, and we drop to the 1 hour chart, we come down here. The 1 hour chart actually gives us our exit right over here. Okay, which is not a great exit because price did go back up a little bit more right here, but it's not a terrible exit. It's better than the exit we got on the 4 hour. We mark out the 4 hour. Let's mark it again on the 4 hour chart. It's right here, right there. Back to the 1 hour. You can see the difference. So we got in back here. Here's our exit on the 1 hour. Here's our exit on the 4 hour. Look, we probably ended up just about break even, or maybe a very small profit. Now, again, you can see ultimately this did come down and went back up. So you can make an argument that, you know what, I'm holding this trade anyways. I'm in this trade for the long term. I understand there's going to be pullbacks, but overall the trend is up and I'm going to hold it. And that is perfectly valid. This came all the way back down, probably back to your entry price on the 1 hour chart. You would have been back to about break even right here. And then boom, price turned and rallied way back up again. Okay. So all of this in here is, you know, a valid move up. And then this is all a pullback in a larger uptrend. So, and again, you could have held the whole thing. So if you wanted to keep this trade, then this is great. But if you're looking to, you know, exit trade, you're looking to just day trade or short-term swing trade. I mean, this trade lasts a couple of days, even on the 1 hour chart. This is still technically a swing trade if you're holding it past the one session. All right. And then the crossover out of overbought happens right here on these little small doji candles, and you could have gotten out right here. Again, your moving average crossover would have been very late. Even on the 1 hour chart, it's late. It's way back here, which is about where you got the 4 hour stochastic RSI exit. You can see the crossover happens on this candle right here. Again, it's very late. You would have been probably near break even. But again, you could have held this trade if you were confident price was going to continue up, hold it through this pullback, and then keep going. Because theoretically, as long as this structure level down here was never broken, right, came down here, as long as this level right here was never broken, the uptrend is being maintained, okay? So in terms of exits, again, you could go for, again, indicator switches, you know, oscillators changing direction, moving average crossovers. You could go for Fibonacci extensions, and I'm really not even going to get into Fibonacci. You could go for nearby highs and lows. You know, maybe you got in here on this candle and you just took it back to this high right here. All right, you would have left money on the table. I'm not exactly a big fan of that, because if this is a new uptrend and this is a swing low to go higher, it's going to go higher than here. But you could have gotten in, you know, on this candle on the 1 hour, had your take profit sitting back at this previous high, a very, very, very conservative target, but you could have done it. Or maybe you go and look at the next swing right here and target this area, you know, a previous major swing, which was up here. That one actually would have been good. So again, examples, moving average crossovers, oscillators changing direction, Fibonacci extensions, candlestick patterns, previous highs or previous lows. Previous highs if you're going long, previous lows if you're going short, right? Stuff like that. Okay, so let me turn off these moving averages. We don't need to see those. Okay, so let's look at, and we'll take all these drawings off just to clean the chart up again. All right, so again, my preference is on the 4 hour. I like using Heikin Ashi candles, but I'm not married to it. I do switch back and forth. And the nice thing about TradingView is you can make Heikin Ashis a favorite. These are regular candlesticks. Here's Heikin Ashi. Okay. So I like to use, like I said, TradingView allows you to easily switch between candlestick types. So here's Heikin Ashi, here's regular. And you can use that. I mean, if you don't like using Heikin Ashis, because Heikin Ashis do have some limitations. They are kind of delayed too because of the way they're calculated. But they also smooth out some of the price action too, and can help you avoid getting in too early. All right. But I like using the stochastic RSI if I'm going to use an indicator. Sometimes I'm just looking at price action. I don't even look at the indicator. It's kind of an afterthought. But if you need a little bit of extra confirmation, use an indicator of your choice. All right. Here is again, going back to this entry on the 1 hour chart. We have a great stochastic RSI entry down here. And then look what happened at that point. The candlesticks, these are Heikin Ashi candles, started turning bullish again right here. We had our first bullish one. Price went up. We have these bullish Heikin Ashi candlesticks right in here. Okay. And we did have an entry. And this is what I'm talking about. The shorter time frames giving you false entries. We had this entry right here. You got a crossover on the out of oversold, right? And then what happened? The price dropped. So again, that's the push-pull between shorter time frames and longer time frames. You have to pick your poison. You have to understand no system is perfect, and you're going to be wrong sometimes. You're going to be early. Sometimes you get in before the corrective move has ended because, even if you're just using pure price action, sometimes you're going to be wrong. But especially if you're using indicators to help you decide on all that, okay? So personally, that's how I do it. And like I said, your exits can be, again, previous swing highs or lows or supply and demand areas, depending what your time frame is or how long you want to hold a trade, right? Are you looking to hold it just for that session? Are you looking to swing trade it where you can allow for more noise and more, up and down within that range? It's up to you. Or you can use an indicator signal, for the oscillator to come back out of an overbought region if you're, in a long position. All right. Or coming out of an oversold region if you're in a short position. Or again, a moving average crossover, although I don't recommend those. I just don't. Or again, using Fibonacci extension levels, right? And just, shooting for a fib level, above your, where you currently are. I'm looking for fib extensions. Yeah. All right. Well, I'm not going to get into that right now. So anyways, yeah, so that's it, guys. Again, I had a request to just talk about entries and exits. So the setup, commitment of traders, weekly chart, 4 hour chart for your analysis, okay, on the trend and where price could potentially be setting up for an entry. And then from there, it's all up to you. Do you stick to the 4 hour and just find an entry on there using price action or an indicator? Do you take that indicator and drop to, say, a 1 hour chart to get a little bit earlier entry, but understanding you might get you might be in too early and get a false signal? Or do you stick to the 4 hour, wait for the signal on your indicator on the 4 hour, but understand you might be getting in late at that point? Okay, right? So that's the decision you got to make. Or do you go down to a really short time frame and look for market flow change? Like if price is pulling back right here, you're going to wait for price to start shifting more bullish. which, you know, here's that pullback, right? Where's the bullish momentum start? Really starts on this candle right here, right? Because we're putting in lower high, lower high, lower high. You know, this is technically still equal high, and then boom, right here, higher high. So here's your entry. Okay. In this case, the stochastic RSI was better because it gave you an entry down here instead of way up here. So, but this is only the 1 hour chart. Maybe on the 15-minute chart it would have been better, but probably not. So, so these are the type of things you have to look at and make decisions based on your risk level, how long you're willing to hold a trade, what time frame you're doing your analysis on, etc., etc. But always be starting with the baseline, which is the commitment of traders, and understand where the big money is flowing, and try to go in that direction until they change direction, because you are greatly increase your chances. Again, not that there are not major pullbacks within those uptrends. So in this case, Rice, the large speculators that we're following are long, okay? But it doesn't mean there aren't going to be significant pullbacks within that. So you can't just blindly jump in long and say, I'm just going to get in anywhere and go long, because you could, you know, get caught in a really big pullback that is not a trend reversal. It's just a pullback within an uptrend. And you want to make sure that, you know, you get in at an optimal place, all right, at a discount in this, and that's where you're looking at your charts and looking at pullback areas, looking at indicator levels can help you decide where the good place is to get in. So, all right, so it's probably clear as mud, guys. This is why I didn't necessarily want to talk about entries and exits, because everybody's got their opinion, right, about how they like to enter the market. And there's no right or wrong way, whatever works for you. I just gave you a half a dozen, you know, ways to do it. And I only showed you one indicator. Well, technically two with the moving averages. I mean, I could have thrown a MACD on these charts. I could have thrown a regular RSI, a regular stochastic, commodity channel index, CCI. I could have thrown, you know, volume on here, right? You could throw just regular volume on here. Volume profile, you know, point of controls, right? I mean, you just go on and on and on. Everybody's got an opinion. So you do what you need to do as far as, okay, I know I want to go long. I'm going to wait for a valid pullback, and then I'm going to use XYZ method to decide when to get in. Here are my rules of when I'm going to get back into the trend. That is what you have to decide. And then the same thing on the exit. Okay, now I'm in the trade. What is my time frame? Am I looking to hold this trade for multiple sessions, or am I only looking to day trade it? That's going to depend a lot about what time frame you entered on. But if you're entering on a 1 to 4 hour chart, you know, in a good trend, you probably can hold that trade for more than one session. But again, you have to decide that. So, okay, but regardless of how long you're going to hold it, what is your exit criteria? Is it a moving average crossover? Again, don't recommend it, but hey, if that works for you. Is it an oscillator changing direction, or, you know, coming out of an extreme level, you know, and changing direction? Is it a Fibonacci extension level, right? Is it a key support or resistance level on the chart, a previous high, a previous low, or just an obvious area on the chart where price is likely to react from? Doesn't mean a full reversal, but it will react from, because everybody else sees that same level, okay? That's what I'm talking about, okay? So you do what you got to do as far as when you actually decide when you're going to enter versus when you're going to exit, and what method you're going to use. My whole point of this is just to say, I'm only looking for longs here because I'm looking at the commitment of traders level. Whoops. I'm looking at my commitment of traders here, and I see that they are long. Okay, they are in the long position, and that's why I'm only, I'm only looking for longs right now, because they have come out of this extreme short level that they were in, and they're heading long. Now they're up here in this very long position, and this could move on for a while, and until if and when, well, it's not a matter of if, it will eventually break and come out of this extreme long area and start heading down again, then my bias will shift more to the short side. But in the meantime, this is what I'm looking at, and that's how I'm making my directional decision, and then I'm dropping to a shorter time frame, waiting for suitable pullbacks. And I prefer the 4-hour time frame. I don't like short time frames. The 1 hour is okay too, to fine tune, especially with an indicator like this, to get a little bit better entry. But I don't go any shorter than that. That's just me. So, all right. So I hope that makes sense, guys. I'm going to leave it there. If you have questions or comments, or you want me to get into it any deeper, please leave a comment and ask any question you want. Make sure you smash that like button either way to show support of the channel. Subscribe if you're just finding it for the first time, and that's it. Hope everybody has a great weekend. It is Saturday afternoon, January 31st, 3 p.m. New York time. I'll be back next week. I am going to be traveling Monday afternoon, and I'll be gone Tuesday and Wednesday. So there'll be no videos probably Monday through Wednesday next week. And Tuesday, I probably won't be trading on Tuesday, so because I'll be tied up. So maybe Monday and Wednesday I'll be trading, but there'll be no videos the first half of next week. But certainly, you know, if you see this, you have any questions, let me know, and I'll be back later in the week to do a little catch up. All right, guys, talk to you all soon. Take care. Have a great weekend.